Tesla might be setting up for one of the most dangerous reversals in the market this year. Just a few weeks ago, the narrative was completely one-sided. Growth was slowing down, competition was heating up, and a lot of people were saying Tesla was already falling behind in AI. Some investors had basically made up their minds. The best days were over. But now, things are starting to shift. Fast. In just a matter of days, two developments have completely flipped the story. First, Cybercab is moving into mass production, and this isn't just another product launch. This is a fully autonomous ride network. No steering wheel, no human control. Second, and this is even bigger, Tesla could get regulatory approval for FSD in Europe within the next 24 hours. And if both of these actually happen, then the question becomes very simple. Is the market still using an old framework to price a company that has already changed? Or, put it another way, is Tesla's next major run just getting started? Alright, let's get straight to it. Here's the bottom line. Tesla, right now, is not about whether you should buy it or not. The real question is, do you have the conviction to step in while the narrative is just starting to shift? Because this isn't one of those slow fundamentals-driven moves where earnings improve little by little. That's not what this is. This is a classic US market setup. Expectations move first. Price follows fast. A lot of people are still waiting for confirmation, waiting for the data, waiting for the next earnings report. But here's the problem. By the time everything feels confirmed, the stock has usually already made a big move. What's driving this isn't how much Tesla is making today. It's the market starting to redefine what this company actually is. And once that shift locks in, Tesla is no longer just a car company. It becomes an AI and autonomous driving platform, and when that happens, the valuation framework changes completely. Which means where the stock is trading right now could just be the beginning of that repricing, and more importantly, when the market goes from almost everyone being bearish to capital starting to flow back in, turning bullish again, those moves are never slow. They're fast, they're aggressive, sometimes even a little out of control. So the real question was never, is Tesla expensive? The real question is, are you going to miss a move that's being driven by expectations? Alright, let's zoom in a bit and look at what's actually happening right now. Because what really moves the market isn't one headline. It's a series of events stacking up. Let's start with the first one, Cybercab. A lot of people have heard about it, but they don't really understand how big this is. This is not just another car. It's not a simple upgrade. This is Tesla pushing a fully autonomous ride-hailing system towards something close to mass production. No steering wheel, no human control. That's a very aggressive move. They're basically skipping the whole driverless phase and going straight for a fully automated future. So what does that actually mean? It means Tesla's business model is starting to shift. They're not just selling cars anymore. They're moving toward operating a network of autonomous vehicles themselves. In other words, going from selling hardware to running a platform, and if that works, the upside is on a completely different level. Now let's look at the second piece, FSD in Europe. And this one is even more important than it looks. It's not just about entering another market. It's about breaking a long-standing assumption. For years, the market believed Tesla's autonomous driving could only scale in the US because Europe's regulatory environment is just too strict, too complex, too hard to unlock. So people treated FSD as a local story, a US-only story. But if Europe actually opens up this time, everything changes. That means FSD is no longer just a tech demo. It becomes something that can scale globally, a real product, a real business. And here's the problem. Most of the market is still stuck in the old view. They haven't connected these two developments. They haven't realized that if both start moving at the same time, the entire narrative around Tesla gets rewritten. Alright, this is where it really starts to matter. Because up to this point, we've talked about what's happening, but markets don't move because of events. They move because of what those events change, and what really matters here is not Cybercab by itself or FSD in Europe by itself. It's what happens when you put them together. You start to see something bigger. Tesla is being redefined. For a long time, the market has priced Tesla like an EV company, a manufacturer. It was all about production, deliveries, margins, classic industrial metrics. Even with AI and autonomy in the story, the market only gave it a partial premium. It never fully treated Tesla like a true tech platform. Why? Because there was no large-scale deployment, no proven model that could be replicated globally. But now, that's starting to change. If Cybercab actually scales, then Tesla is no longer just selling vehicles, it's operating an autonomous network, and that looks a lot more like a platform, something that can generate recurring revenue, expand over time, and grow beyond physical units. And if FSD opens up in Europe, that's even bigger. Because now you're not talking about a US-only system, you're talking about something that can be copied, deployed, and scaled across multiple markets. Put those two together, and the conclusion is very different. Tesla stops being just a hardware company. It becomes an autonomous driving platform, powered by a continuously improving AI system, and companies like that are not valued the same way in US markets. Nobody is looking at a simple PE ratio. Early profits don't even matter that much. What matters is scale. How big can this get? Where are the boundaries? Can this become infrastructure level? If you look back at other companies that went through this kind of shift, once the market believes they control a platform, valuation doesn't grow in a straight line. It jumps. Because platforms scale, they replicate, they expand. That's their nature. And here's the disconnect right now. Most of the market is still using the old lens. They're focused on how many cars Tesla sold, what margins look like, who the competitors are. That's single quotes as legacy thinking. But some capital is already moving ahead, looking at Tesla through a different framework: AI, autonomous networks, long-term scale, and right there, you get the gap, the expectation gap. On one side, a market still pricing the old story. On the other, capital already positioning for a new one. And when that gap gets wide enough, price has to adjust fast. Every major move you see in the market comes from that kind of adjustment. So what you're looking at right now is probably not a move that's already played out. It's the early stage of a repricing, a process where the market is slowly catching up to a story that has already started to change. But there's another factor here, one that a lot of people still underestimate, and it shows up in every major run: the shorts. Over the past few months, Tesla has been one of the most heavily shorted names in the market. It almost became a consensus trade. Everyone had the same idea. Growth is slowing, competition is rising. Valuation looks stretched, so capital kept piling into short positions, and on the surface, that logic made sense. But here's the problem. The market is most dangerous when everyone thinks they're right, because the moment the narrative starts to shift from unanimous bearishness to disagreement, and then back toward bullishness, shorts are no longer just wrong. They're trapped, and they have to do one thing: buy back their positions. And once that process starts, it feeds on itself. Price goes up, losses start building, pressure increases. They panic, they rush to cover, and covering means buying. More buying pushes the price higher, which creates even more pressure. That's how a short squeeze builds. So this move is not just driven by bulls stepping in. Part of it is forced buying. And forced buying doesn't care about price. It only cares about getting out. That's why the most explosive rallies, the ones that feel almost irrational, usually happen when sentiment was at its worst. When the narrative flips, when positioning is wrong, and shorts start getting squeezed, that's when the move really accelerates. So now, the real question is, what happens from here? Instead of trying to predict one outcome, let's look at this the way the US market does. In scenarios, 3 realistic paths. First, the bullish case, and this is the strongest one. The story keeps building. Cybercab, FSD, everything keeps getting more attention. The narrative gets stronger, capital starts flowing back in, and sentiment shifts from waiting to chasing. And when that happens, the stock doesn't just grind higher, it accelerates faster and faster, sometimes driven by pure momentum. Second, the neutral case, the stock moves up first, prices in part of the expectation, and then slows down. It chops around, consolidates the market, waits for more data, real deployment, regulatory clarity, actual usage. And honestly, this kind of pause is very normal in US markets. Now the third scenario, the weakest one. The news doesn't fully deliver in the short term, or it comes in slower than expected, so you get a pullback, a reset, some of the earlier excitement fades, and positioning gets cleaned up. But here's the key point. Even in that scenario, it looks more like a pullback in momentum, not a break in the core story. Because once the market starts accepting a new narrative, once Tesla shifts from a car company to an AI and autonomous platform, that kind of perception is very hard to reverse. So stepping back, this doesn't feel like a move that's already played out. It feels like something that's just getting started. So when you put everything together, this Tesla opportunity is not about waiting for earnings to slowly play out. It's not that kind of move. This is a classic repricing story, a shift in expectations. When a company goes from being constantly doubted to gradually being believed again, price reacts fast, very fast, because capital doesn't wait for everyone to fully understand what's happening. It moves early, right when expectations start to change. So if you're asking what the strategy is here, it's actually simple. This is not about waiting for a pullback, not about waiting for a perfect entry or a safe price. This is about recognizing when a new narrative is forming and choosing to follow it. You're not trying to time it perfectly. You're asking one question: can this story take over the market? And if the answer is yes, then the real move usually starts while most people are still hesitating. While it still feels uncertain before it feels comfortable, that's how these runs happen. They don't wait for you. They don't give you time to get ready. They just go. And if you want more breakdowns like this, looking at markets through expectations and capital flows, make sure you're subscribed.